equal highs. As a result, we can consider initiating a short position from the upper supply zone. Since the market has already absorbed the stop losses of retail traders, there is no longer a need to collect more stop losses. As mentioned previously, the primary objective of smart money is to clear out all the stop losses of retail traders. To increase the likelihood of a successful trade with a high chance of winning, it's essential to enter the market after stop losses have been cleared. It's important to note that if the price doesn't clear the liquidity before reaching a point of interest, there's a strong likelihood that the price will use that zone as a source of liquidity to drive its momentum. Now, let's move on to the second practical liquidity pattern that we should consistently look for in the market: trendline liquidity. Let's start with the bullish scenario. Consider a structure like the one illustrated on the left side. We can see that the price formed a bullish BOS to the upside, leaving a great inefficiency behind. Following the creation of a new major high, it retraced downward and then began forming a series of small break-of structures with extremely tiny and choppy movements to the upside without any significant liquidity sweeps. The key factor here is the repetitive formation of these small break-of structures. In this scenario, the price is slowly moving upward while forming new higher highs and higher lows that are in close proximity to each other. As a result, a trend line is generated by these minor highs and lows. Retail traders who rely on trend lines and chart patterns enter the market every time the price touches the trend line, placing their stop losses just below it. This approach results in the formation of a substantial liquidity pool positioned just below the trend line, waiting to be cleared by the market. Consequently, numerous stop losses are closely aligned with the trend line and are positioned by retail traders. In this scenario, it's highly likely